the way that smart money trades and the way that we trade, we as in individual traders, retail traders, even like large hedge funds, okay, may not operate the same way as smart money. What they're doing is scaling in and out. And again, this is my interpretation, okay? My interpretation is they're shorting on the way up, exiting on the way down. Now, us as retail traders, we're not doing that. Or at least I would hope not. I don't do this, but I'm not shorting in here, shorting in here, shorting in here, shorting up here, and just absorbing a lot of drawdown. I'm not absorbing that. I can tell you what happens. The first time you do some shit like that, it's going to keep going, and then your account's going to be cooked. So I may not do that. I hope that you wouldn't do that. But they're shorting this, right? And as the market's going lower, okay, they're going to be able to exit at a profit, exit at a profit, new lows, exit at a profit. So shorting on the way up, buying on the way down, or vice versa. They could be like if this were inverted, for example, they might be buying on the way down. And then when the market goes higher, they'll be scaling out on the way up. We have the luxury as retail traders to not do that. And we can decide at any point that we want to get into, like for a market order, for example, we can just get in when we want. The luxury that we have is we don't have to sit through drawdown. Cameron says the no stop loss gang strategy. You're fried. What we're doing, okay, or at least what I do when I get to the charts, first thing I'm looking for is liquidity, period. Okay, my eyes always gravitate towards consolidations, but first is going to be either equal lows, low resistant lows, or equal highs and low resistant highs. That's where my eyes go to. Once I have that, so like let's say today, for example, Sunday evening, set up all this consolidation and this low is kind of ugly because there's no wicks right there, but on a 15-minute, on maybe a 1 hour, this is going to be low resistant lows. The fact that it's consolidation, even better. The fact that this is a London low, that's even better. That adds to that confluence of the lows plus a session low here, meaning London. So in my mind, the very first thing is at some point, the market's going to go here. That's what I think. Okay, I'm not thinking in terms of absolutes, but I'm saying that's what crosses my mind. At some point, the market is going to jam that. Could it be today? Maybe. Could it be tomorrow? Maybe. There's like weekly profiles and things that we could do, but honestly, I'm a little bit lazier than that. So this is why I always tell you, what I'm waiting for is evidence. Okay? I'm waiting for evidence to tell me what it wants to do. So we have this consolidation with the lows. I feel like the market is going there at some particular point. Could be the AM session. They might run that during lunch. Or maybe the PM session. I don't know. You guys know how my timing is. I'm pretty accurate when it comes to directional bias, but I'm not always right when it comes to the timing. Look at NASDAQ last week. I called out 17,988. We didn't even get that till Friday. So I was off by like 5 days. Anyway, point is, I think the market's going down here, just like you guys pointed out in the Discord. Now, as I mentioned earlier, as price is trading higher, I'm not just going to short and short and short and short. I'm not going to do that. I'll allow smart money to do that. When the evidence has been shown, right? This low right here at 8:55 a.m. Central Time. Why is this low important? Well, the low by itself to me doesn't mean anything, but it is not just this high and the way we left that, but it's these lows, okay, and this high and where that low is in relevance to both. So the target of those lows, if we measure up to that high, okay, this is where that low gets important. Because now, what has the market done? Created the high. Look at that wick. It cannot be more obvious. The stop run cannot be any more obvious. So we do rally a little bit and then it slams lower, right? That's what makes this, to me, a mitigation. Now, I was also watching this imbalance too, and this is what was a little bit tricky about this. The micro side, I think, closed outside of it. We trade into the overlap. You guys see what I'm talking about? It's the two price levels, really, that the orange box and the gray box overlap. And it's like the darker shaded area. Okay? That's where they overlap. The bodies are respecting that. And they went as high as 50% of the mitigation. And this is why you see that on my chart as well. Right there. Okay, I'm measuring from the body, which is the low end of the mitigation, and the body of the high end of the mitigation. You see that? So if you remember from Friday, how to trade like smart money, part 1, but it's just how to trade like smart money. We talked about how when you have a large imbalance, you can cut it in half, right? Well, the mitigation and pretty much every concept, you can do the same. Okay, you can cut it in half, just like a pizza. So as long as the bodies are respecting at least the 50%, sometimes it'll trade to the higher end. I usually don't like that. But sometimes the bodies will do that. They'll trade outside the mitigation, and then the bodies will close inside of that. And that's still permissible. I don't think we did that today because, again, these imbalances are here. And when you have a super weak market, you're not going to expect a deep retracement. On the upside, at least. Okay? If the market's heavy, if the market's weak, it's not going to give you an entry way up here. It's like this short-term high. It's not going to run that short-term high. When I came out in the Discord and I said, relax, the Dow is weak and heavy, how do you get to that conclusion? Well, dude, I've taught you order flow before. I've taught you to look at well, not everything that's on the chart, but look at the imbalances. Look at up candles. Look at inverted concepts, right? So before we get into the details of this, there's a reason this 50% is here, right? We cross 50%, which means we have the market tipped its hand. The market saying, hey, I'm crossing 50%. I'm likely going for these lows down here. I'm not going to do it in a straight line. Oh, it only does every once in a while. It almost never does that. Right? Your 50% level is here, which means if the range has been established, the lows have been established already. If the high has been established and we've crossed 50%, that is your wake-up call. That's, banging on the door. Boom, 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 boom. Wake up. I'm telling you that if you've been long, this next rally here is your chance to get out before the market trades lower. That's why I call this a mitigation, okay? Because that's its function. We cross 50% back into a premium, all right? Premium. That means this imbalance, it is an imbalance, but it's in the upper 50%, which means it's in a premium. This mitigation, although I keep it orange, that's still a premium mitigation.